Hello, my dear students, and welcome back. I know your exams are just around the corner and the tension must be building up, but please don't worry, okay? We're in this together. Today, we're going to do a super quick, super simple revision of a very important chapter, Sources of Business Finance. Let's get right into it. You know, when you're just scrolling through your phone, ordering food from Zomato, or you see an ad for cred, have you ever stopped to think these companies are worth thousands and thousands of crores? Starting something that big takes a lot of money. So where does all this pesa come from? Well, that's the big mystery we're going to solve today. Okay, so first things first, let's get down to the basics. Every single business, whether it's a tiny little cafe in your neighborhood or a huge company like Reliance, needs money. It needs money to get started, it needs money for all the daily expenses, and of course, it needs money to grow bigger. It's really as simple as that. Now, this money that a business needs, it has a special kind of fancy name, business finance. The textbook definition is right here for you, but I want you to remember just one word, lifeblood. Just like our body needs blood to work, a business needs finance. Without it, the business just stops. Remember that word, lifeblood. It'll get you good marks for sure. Right, so a business needs money for all sorts of things. But think about it. The money you need to buy a huge factory is different from the money you need to pay the daily electricity bill, right? That's why we split the money a business needs, its capital, into two main types. So let's look at the first one, fixed capital. What do you think that is? The clue is in the name itself, fixed, something that stays in one place for a long, long time. Exactly. Fixed capital is the money you use to buy all the big, heavy, long-term stuff. Things you buy once and they last for years. So for that little restaurant we're talking about, it would be the big oven, the refrigerators, the tables, the chairs, all those things that are fixed and don't change every day. That's your fixed capital. Okay, so if fixed capital is for all the big, permanent things, what about all the daily kharcha, the day-to-day expenses? Well, that brings us to our second type of capital. And that, my friends, is working capital. You can just think of it as the business's daily pocket money. It's the money that keeps the business working every single day. You know, buying fresh vegetables, paying salaries to the staff, paying the bijli ka bill, all of that comes from working capital. So now we know why a business needs money and for what. The next big question is, where does it get this money from? Let's take a look at our master map of all the places a business can find funding. Okay, look closely at this slide. This is like a cheat sheet for the whole chapter. Go on, you can even take a screenshot. Now, you can see there are 3 ways to classify funds. But listen carefully. For your exam, the most important one is based on ownership. So that's what we're going to focus on today to keep things simple. And under ownership, the choice is actually super simple. It's either apna paisa or udhar ka paisa. Your own money or borrowed money. That's it. That's the biggest decision a business owner has to make. This little table makes the difference so clear. With owner's funds, apna paisa, you are the complete boss. You keep all the profits. But if the business fails, the risk is all yours. With borrowed funds, udhar ka paisa, you have to pay a fixed interest, no excuses, but you don't have to share control of your company. See? Each has its own pros and cons. Let's talk about owner's funds first. I am sure you all watch Shark Tank India, right? You hear the founders say, I'm looking for 50 lakhs for 2% equity. What do they actually mean? Well, they're selling a tiny piece of their company like a small slice of a pizza. And that tiny slice of ownership is called an equity share. So why would anyone sell a piece of their own company? Well, for one, the money they get is permanent capital. The business never has to pay it back. Also, if the company doesn't make profits, it doesn't have to pay any dividends. And finally, you're not putting any of your company's assets at risk. It's like finding a business partner, not a moneylender. Okay, apart from selling shares, there's another very smart way to get owner's funds. And this one comes from inside the business itself. It's called retained earnings. This is the simplest concept ever. Imagine the business made a profit of 100 rupees. Instead of giving all 100 rupees to the owners, the company retains, or keeps, maybe 30 rupees, and puts it back into the business to help it grow. That 30 rupees is the retained earnings. The textbook also calls this plowing back of profits. You're just using your own savings to make more money.
Alright, enough of apna paisa. Let's switch over to udhar ka paisa, borrowed funds. Now, a very common way for big companies to borrow money is by issuing something called debentures. Don't let the name scare you. A debenture is just a fancy IOU certificate. The company gives this certificate to people and promises to pay them a fixed interest every year.
Now, this is a pretty clever move. Why? Well, the interest the company pays on these debentures is a tax-deductible expense. That means it helps them save money on their taxes. And the best part? The people who buy debentures are just lenders. They are not owners. So they don't get any voting rights, and the owners keep full control of the company. But, and this is a very important but, it's risky. That fixed interest payment has to be made no matter what. Even if the company is making a loss, the interest has to be paid. It becomes a permanent burden on the company's finances. So it's a double-edged sword. So we have owners' funds, borrowed funds, shares, debentures. It can feel a bit confusing, right? How on earth does a business choose the right one? Well, the secret is that there is no single best source. It's all about finding the right fit for the right situation. So, a business owner just has to ask 4 simple questions. 1. What is the cost? How much interest or dividend will I have to pay? 2. What is the risk? Can I guarantee the repayment? 3. Am I willing to share control and ownership of my company? And 4, and this is crucial, match the time period. You should never use a short-term loan for a long-term project. Whew! We've covered all the main ideas. You're all doing so well. Now, to make sure all this knowledge is locked in your brain for the exam, let's do a quick rapid-fire revision round. Are you ready? Let's go. Okay, first question on your screen. We just talked about this. It's when a company uses its own profits to grow. What is that other name for plowing back of profits? Come on, think. And the answer is retained earnings. Of course it is. I hope you got that one right. Samjay, did you understand? I bet you did. All right, question number 2. Which shareholders are known as the residual owners? Remember, they are the real owners, the ones who take the biggest risk. Who are they? It is the equity shareholders, absolutely. And why residual? Because they get the residue, whatever is left over after all the loans and debts have been paid. So it's a high-risk, high-reward situation for them. And for our final question, this is a thinking one. Imagine a shopkeeper needs extra money for just 2 months to buy more stock for the big Diwali sale. Should he sell a part of his shop's ownership forever, or should he just take a simple 2-month loan? Think about it. Matching the need to the source is everything. That's all for me today. All the very best for your exams, Beta. You're going to do great.